Unless something happens, we could be facing some significant challenges. And just to back this up a little bit, there's a lot of focus on new, there's a lot of focus on the ZEV mandate, there's a lot of focus on the manufacturers pushing products into the marketplace. What we need to do is to get the used car market moving on electric vehicles.
Welcome to the Automotive Business Podcast, the strategy room for the UK automotive trade. We bridge the gap between the retail forecourt and the corporate fleet to find the margins that others miss. I'm Adrian Simpson, and we're going from the forecourt to the fleet. Our guest today is the Insight and Strategy Director at Cox Automotive and the Chair of the Vehicle Remarketing Association. He's the architect behind the industry's most accurate forecasts, maintaining a 97.2% accuracy rate, even in the most volatile years. Philip Nothard, welcome to the show. Philip, we will get straight into it. You've noted that tactical registrations, a relic of the industry's past, are back in a big way. Firstly, for the uninitiated, explain what that means. And for a retailer, does this false volume actually help the bottom line, or is it just inflating market share figures whilst destroying profit per unit?
I think there are several answers to that. Let's start off with the tactical or pre-registration activities, however it is named. So essentially, there are, particularly in the pre-pandemic period, there was always months where the manufacturers would look at getting certain registrations into the marketplace. That would be either through themselves, so they'd register those vehicles in their own name, and at that point you'd put an owner on that vehicle, or they would register it in the dealer's name or a name of the dealer's choosing, but at that point there would not be a end user. So that vehicle would be, as far as the DVLA and the registration numbers are concerned, it is registered. The fact that it's never going to move anywhere until it gets its second owner, that is what a tactical or pre-registration vehicle is. What that does is it attracts, in most cases, additional discounts and incentives for the retailer, the dealer, or that manufacturer to do that exercise. Predominantly, it's done at the end of the month. So the phone calls start, and if we can do these extra levels of discount, will you register these vehicles? From a consumer perspective, 9 times out of 10, it's a good proposition because you then start to save a high level of discount against what that vehicle would have been new because of the incentives that are against that. We saw that quite heavy in the pre-pandemic period. As we're now starting to see the ZEV mandate here in the UK, the thresholds that is in the UK for electric vehicles, we saw it start to return second half of last year, really. June, we saw high levels of it. And then again in September, we saw high levels of that activity starting to take place. And that's because June is a end of a second quarter and the half year point. So that turns the focus onto the manufacturer. Where are they in terms of market share? Where are they in terms of their registration volume against their peers? And secondly to that is where are they against their ZEV mandate or their zero electric vehicle mandate threshold, where they need to achieve. So it kind of triggers, and that again happened again in September, and I would suggest it probably will happen again at the end of March, if not happened already in the month of January. But I must stress the levels that we're seeing last year and this year are lower than what we saw in the pandemic period, but it's certainly back into the market again that we're seeing this increased levels of tactical and pre-reg activity.
So is that actually helping the bottom line, or is it a bit of a red herring?
In some cases, when you look at the headline numbers coming out from the SMMT and where the UK market is in terms of registration achievements, it can be a bit of a red herring because it gives the market a false sense of achievement and volume, whereas really that is not necessarily, those cars are not necessarily ended up on somebody's driveway or being driven around. They're just registered in the marketplace. So when you start to see some of these numbers, it does give you a false sense of performance, which is the bit that we talk a lot about when it comes to government conversations, because when the government thinks we achieved the ZEV mandate last year, what's the problem? We've got now a higher level of the threshold this year. It's how it was achieved last year. If it's an unnatural kit, then it's not going to be that easy to achieve again this year is the challenge.
So what are those conversations with the government like? How do you make them understand it? How can you quantify that? How can you factor it in?
I think part of the conversation really is understanding, because the government can see the big headlines, they can see what's being pushed out in terms of the media and the big headlines, but it's understanding what's happening in reality behind all of that. We're in a fragile market at the minute. Just this week, a large UK dealer group has talked about an average £11,000 discount on EV vehicles being incentivised. So you've got to say, if there's that average level of discount, how natural a market are we actually in? How financially damaging is it to the manufacturers and the dealers if they're having to give that level of discounts? The best financial marketplace is when you've got a healthy, natural supply and demand. When you've got thresholds such as this year, you've got a 33% ZEV mandate target for the manufacturers to achieve in 2026 from a 24% last year. That is not creating a natural market of supply and demand, which is financially damaging in a lot of the cases for the manufacturer or the dealers.
So would you say that the mandates are counterproductive? They're creating that fragility and that jeopardy in the market?
To a degree, yes. If you look at it at the highest level, the net zero 2030, 2035 is the right thing to try and achieve. A new energy vehicle, be it hybrid, plug-in hybrid, or an EV marketplace. The challenge at the minute is when you've got a political and economic climate that we've got currently, and then there's these thresholds for the manufacturers and the dealers to achieve, it's not creating a financially stable marketplace for the manufacturer or the retailers currently in the marketplace. 33%, and bearing in mind the February figures have been published as we're talking today, yes, we've seen volume year-on-year increase in the month of February for battery electric vehicles, and the year-to-date volume has increased for battery electric vehicles, but the actual market share has declined marginally. So the battery electric vehicle share of the total market in February and the total market year-to-date has actually declined year-on-year, not increased. And this March is going to be a crucial line in the sand for where potentially 2026 is going to head for the rest of the year.
There's so much to talk about from that. Firstly, what's the alternative, or what would be your alternative to those mandates, and why has that market share of battery electric vehicles declined?
I think there's two things with the market, and the debate is, have the people that are looking at transitioning to electric vehicle transitioned, those that have the charging infrastructure around them, whether it was domestic or public charging or destination charging, or they have the kind of vehicle ownership driving behavior that suits the battery electric vehicle. Have those people transitioned across already and made that choice? And we've seen that increase, be it through forced movement or natural movement, be it through the benefit in kind, the taxation benefits, notwithstanding the announcement last year from the government around the pence per mile that's due to hit the market in 2028. If it does hit the market in 2028, we've got consumers in the marketplace that are maybe considering transition to electric vehicle that then think about, am I going to be faced with a 3 pence per mile charge in 2028? In 2 years, I could be facing a cost per mile on my EV that I'm being pushed into transitioning to. That then adds the question to it as well. That whole transition to me, personal opinion, is that there are deadlines in place, be it the 2030, 2035 target. The manufacturers have a finite period of time to become an electric vehicle producer if they want to stay in the UK. So that should be a good enough incentive, because these things take time. Production shifts take time, manufacturing takes time. Those should be enough incentives to transition to an electrified market without the significant fines and challenging thresholds. Bearing in mind, after this year, it really starts to accelerate out to 2030. From 38% today to 80% in 2030. That's a big shift. At the minute, we're in this sort of stalled marketplace. So unless something happens significantly, we could be facing some significant challenges. And just to back this up a little bit, there's a lot of focus on new, there's a lot of focus on the ZEV mandate, there's a lot of focus on the manufacturers pushing products into the marketplace. What we need to do is to get the used car market moving on electric vehicles. There are lots of products into the marketplace. I'm predicting a 1.8 million by the end of this year be in the used car market. We need the focus to shift from new to used. What is for the used car buyer to buy an electric vehicle? New's fine. Heavy discounts, benefit in kind, tax benefits, buying it through your company, etc. It's what's happening with the used car marketplace. Because every time we do something new, it hits the residual value used. It then devalues the used car values. And that's the bit that we need to start to stimulate and get into a more natural market.
Hi everyone, I'm Jessica Bird, Editorial Director at Asta Media. If you work anywhere in the motor trade right now, you'll know just how quickly things are changing, from electrification and regulation to margin, supply and customer expectations. That's why on the 14th of April at 11 a.m, we're hosting an Asta Automotive webinar in partnership with Cox Automotive. Cox's Insight Director Philip Nothard is one of the most respected voices in the sector. He'll be sharing the latest data-driven insights along with what they mean in practical terms for all of you out there on the ground. I'm excited to be hosting the session myself and learning from it, getting into what really matters for your business. It's not just up to me though. Those in attendance on the day will have the chance to submit their own questions for Phil, putting his significant expertise through its paces. There's only going to be so much time though. So if you've got something burning that you want to put out there, sign up now to be at the front of the queue. It's free to attend, it's online, and you can join from wherever you are. Take a moment out of your busy day to get the latest scoop with Asta Media. Just head to webinar.motortradenews.com to register your place. I'll see you there.
Let's talk about a few things. You said just a minute ago about if the price per mile happens. Do you know something we don't, Philip?
Not necessarily. I think it only takes anybody that's seen the government's U-turns or flip-flops over recent months that anything can happen between now and 2028. There is consultation taking place at the minute around how it will be implemented, how will they process the charge of the 3 pence on electric vehicle and 1.5 pence on hybrid vehicles. Again, 2 years is a long time in today's market at the minute for anything to happen between now and then. I don't know anything more than anybody else in terms of speculation. Clearly, as we've seen, anything can happen with the changes that go at the minute.
So you were just talking now about the used electric car market, and it's something that I've talked to other guests about. I find this absolutely fascinating. There was a report that came out saying that the quality of those batteries in used electric vehicles is actually a lot better than people thought, and so that should give people confidence. What needs to be done? What can government do if they put all these processes and systems in place to make the new electric car appealing to people? What can they do to kickstart the used electric car market?
I think there's various things. I think the cost per kilowatt between domestic and public charging needs to be reviewed. I think there's a lot of drivers that will be put off the risk of needing to charge their vehicle on the public network and the cost per kilowatt that incurs. We are obviously seeing acceleration of infrastructure investment, but I think there's questions whether the 1.2 billion that went towards the electric car grant increased recently in November. Would that money be better spent on infrastructure and maybe VAT reduction on public charging and cost per kilowatt on an electric vehicle that make some of those used car buyers think about, actually, I can buy an electric vehicle. It would suit our driver requirements as a used proposition, because clearly what we are starting to see in the marketplace and some of the big dealer groups and smaller ones now, those that are starting to get into used electric vehicles understand the low maintenance on them, how they are a good value proposition. They're doing very well out of them. There's just not enough of the consumers that understand that electric vehicle market. There's still those myths out there about degradation of the battery, the range, things like this, that actually there is a lot more education to be done in the consumer market around the whole battery electric vehicle marketplace. Without quoting manufacturers, there is some good product out there in the market that looks very good value as a used proposition. Now, to carry out that, it's a good used proposition if you have the domestic charging and the destination charging. That's the key. If you can't charge the vehicle at home and you can't charge at your place of work, that then creates a challenge. So you will have a proportion of consumers out there that want to transition to electric vehicle, are looking at the value of these used battery electric vehicles in the market, but it just doesn't suit. It's taking months to put a charger in at your home. You're on waiting list to install a home charger. You've got consumers transitioning to an electric vehicle because it works out in terms of taxation benefits, etc. But then they're waiting for 6 months to get a charger put on their home. That needs to change, and it has to be done quicker. And that's where I think the government can get quicker in support that use. To go back to the earlier point of a natural supply and demand, the more you keep throwing in at the new car side, the more you're forcing manufacturers into heavy discounting, the more pressure it puts on residual values. It then creates that volatility of used battery electric vehicle values. That then plays into caution and risk. So if you're seeing these used values of battery electric vehicles fall, the dealers are less likely to invest because it's more risk. The consumers are less likely to buy because of the volatility and the risk in that product. For me, less focus on the new, let the new naturally get to where it needs to go without the heavy discounting, without the heavy incentives, focus a little bit more on the used. Then if you get the used residual value at the right price, your cost of ownership starts to balance out a little bit better then.
So if we look at this from a fleet perspective, what's the commercial fleet charging look like? And with fleets transitioning to EVs?
It's improving. The fleet sector is heavily investing in their own infrastructure. They're heavily investing in supporting their drivers. If you start to look at that fleet sector, they start to think about that ESG proposition as a business. That transition to a more net zero fleet is the right thing, and they're all heavily focused on that. But it's again, when you've got a company policy trying to transition to an electric fleet, but actually you've got employees that just cannot charge that vehicle at home, or they cannot charge it on a public network on the routes and their destinations that they drive on a daily basis. So there is a disconnect there, and that's just in cars. When you move that into the commercial vehicle market, the LCV sector, that issue accelerates quite significantly. They take that vehicle home at the end of the night and they can't charge it. Then how do they do their job the next day, etc. So there's the problems that we're seeing in cars is actually amplified when you start to look at that commercial vehicle sector.
If we have a look at another part of the setup from a fleet perspective, I think Cox data shows that 1 to 2 year old EVs have plummeted in value by about 37% since 2022. So how do fleets and dealers stop their balance sheets from bleeding out whilst the supply continues to outpace demand?
That's a regular question now. I think that has now started to stabilise. I think from 2022 to the end of last year, we've seen that depreciation now start to stabilise. I think the fleet operators have caught the cold. They've felt the financial pain. They're still working their way through that. I think clearly some of those depreciations that we saw and that readjustment of high depreciation in the first 12 months of that vehicle's life did catch a lot of the fleet operators out, hit their balance sheets fairly heavy. And that's again back to the used proposition, because at the end of the day, they're holding onto these vehicles, whether that's through lease extensions or just holding them back from the market until the market stabilizes enough that they can put those products into the open market. What we've learned is that used vehicle market, and it isn't necessarily just EVs, you've got 75 and more manufacturers fighting for a 2.2 million new car market. That creates competition, it creates price competition, it creates complexity for the fleet operators to choose the right product, manage those residual values when they come back into the market. But what it does create is risk around that residual value, that used car price, because what's coming into the marketplace, particularly from some of the new entrants that are coming in, that cost of entry then hits what that 2-year-old, 3-year-old vehicle looks like as a used proposition against what you can achieve new. Some of the complexity starts to play out. So I think back to your question about the fleet operators, a lot of them have felt the financial pain from that depreciation loss. They've managed their way through it, they've learned from it, and they will be reassessing their residual values going forward to make sure they're not as they were exposed through the last sort of 12, 24 months.
And talking about the new entrants you were mentioning just now, obviously everyone seems to be talking about the Chinese brands that have come over, the Changan, BYD, JQ, Omoda. Does that mean in your opinion, legacy OEMs are fighting a losing war on affordability, or can they still rely on brand loyalty?
I think there is still, depending on the brand, there is still an element of brand loyalty. Some of that will be down to profiles and things like this. So there is still some brand loyalty out there in the market. I wouldn't necessarily write off a lot of the traditional, I prefer to call them traditional rather than legacy. Legacy seems a bit of already history. I think from a traditional market, traditional OEMs, they're coming up with new strategies. They're coming up with new competing products. Some of the pipeline products coming in. They're learning now of how do they partner with some of those Chinese OEMs to become more cost efficient in their production, or they're actually looking to say, actually, we've gone heavily into the EV, pull back on that a little bit, and let's focus on hybrid and plug-in hybrid technology in the short to medium term, which you would have seen in the headlines over recent weeks. I think one thing that we are wary of is if you think about what's happening over in China with a 34 million production in 2025 out of a 95 million global production. So China produced a third of global production in what you might class as a contrasting domestic market over in China, and very price competitive. So when that product comes out of China, it becomes more profitable because they're competing against more expensive product, isn't as efficient, so they can be more profitable per unit. But when you start to look at Europe, South America, UK, at what point do the Chinese manufacturers become competitors to themselves? At what point does it actually move away from the Chinese new entrants? I think we say Chinese, they're not all from China, but predominantly they are. They are entering the marketplace to compete against the traditional OEMs. But the more of those that enter the market, they become the competitors to each other, which will potentially drive down the price even further. And then to your question about the traditional manufacturers, where does that then leave the traditional manufacturers? Because they're sat in the middle then of Chinese manufacturers going head to head on price and China being focused on production.
What's the appetite been from Fleet for the new Chinese brands?
It's increasing. I think the consumer market is adopting the Chinese manufacturers. I think they are offering good value, good product, good tech. People have tested them. We're not really seeing heavy levels of volume in the used car marketplace to test their residual value resilience. That will be the next test, really, as we move through 2026 into 2027, when we start to see the return of some of these volumes come back into the used car market and off the fleet into the marketplace. So we've yet to see the residual value resilience. The fleet operators are moving into that market. And I think one thing is this perception that the Chinese manufacturers are EV manufacturers. They're not. EV is a proportion of their model lineup. If you look at some of the product that's in the pipeline from some of the manufacturers coming out of China, hybrid and plug-in hybrid technology is within their R&D for the minute. EV was their point of entry because that's where they could come in and offer a lower cost of entry against the traditional manufacturers. But they're also looking to actually, the European and UK consumer market want plug-in hybrid and hybrid product as well as EV. And that's where they're starting to move a little bit more. So if you think about the traditional manufacturers, it's not the EV market that's the threat. It's the general market that is a threat from the new entrants coming into the marketplace. And the speed of life cycle of new product coming in, because they can produce cars a lot quicker than our traditional manufacturers can or could.
So if we go on a slightly different angle, 2024 saw the surge of agency and hybrid networks. Now that we're in 2026, has this actually delivered price stability, manufacturers promise, or has it just handed the competitive edge back to the independents?
I think the agency model was, as you say, in 2024, the big topic of conversation. That's gone by the wayside. There's only a handful, if that, of manufacturers that operate agency. One of them, most dominant one, is the Mercedes brand. So agency model in hybrid agency has gone on the back burner for the time being by the manufacturers. That's not to say it won't necessarily return, but I think Mercedes have delivered it. I think the Mercedes network are now seeing the dividends from that. It took a little bit of work through to get there. But I think generally agency model and hybrid agency is not really a priority at the minute for the manufacturers. But as I say, I think they will return to that as a marketplace. But I think that price stability, it's the right thing. I think for any consumer to be able to walk into any dealer representing that brand, wherever you are in the UK, the deal you should receive should be exactly the same as anywhere else. I think that is the crucial point with this. Complexity of part exchanges and things like this start to play into it, which makes it a little bit more complex when the manufacturers are trying to take that agency ownership.
Whether you're managing a local forecourt or nationwide corporate fleet, the challenges of 2026 require a specialised perspective. Business Motoring is the dedicated home for SME fleet managers and professional motoring advice. For the deep dives into operational strategy, stay right here on the Automotive Business Podcast. If I'm looking at it from the perspective of a fleet manager at the moment, and you've got these 2 million new units entering the market, should I be locking in lease rates now? Or is there, in your opinion, a pricing cliff coming that makes the current contracts look like a bad bet?
Yeah, crystal ball in here now, Adrian. I think we don't know. I think the quick answer is suspect that the next 2 years will be quite volatile. And price commitment and residual value management will be crucial for any fleet operator at the minute. Things that can change very quickly, new product coming into the market, can really shift the dial quite quickly. But at the same time, your lease operators need to be competitive with each other. They need to plan. They need long-term financial planning from residual values. But crucially, I think 2026 will be a similar year that we're in 2025, where we have got quite a bit of fragile volatility in play. We've got the leasing companies, some of the operators are still working through some of their more heavily leveraged residual value product that's still to come back into the market from 2 years ago, 3 years ago, when before the value started to realign and reset themselves. But they'll, at the same time, they're trying to set residual values now for the next 3 years. The 3-year outlook now becomes quite blurred to a degree, because if you've got, say, back to the new entrants, when you've got 75, give or take, manufacturers fighting for market share, fighting for that lease deal, fighting for the consumer, that creates a lot of competition and starts to ask the question, are we a new 2 million new car market, or will that pressure push that new car market significantly higher? Does the used car market constrain because the new cars become so low cost of entry, so affordable? But then what does that start to do to used car values if that becomes the case, which will then hit residual values and depreciation in the used car marketplace, which is, when we look at that EV depreciation, that was what happening there. You had a lot of product going out into the market, a lot of the fleet operators putting EV product out into the marketplace. You had a significant uplift in the pandemic period where the drivers were shifting into the battery electric vehicle world through tax benefits, benefit in kind, cost of ownership. But they all came back into a used car market with little or no used car demand for used battery electric vehicles. And that's when we started to see an oversupply and a heavy depreciation. And that's the bit thinking forward. What does that look like in the future? What does the 3-year market look like? That's going to be a challenge for the fleet operators now.
Surely, with all that stock, with this potentially new confidence in batteries and the way these cars are put together, there seems like an amazing amount of money that could be made from a business if they can just get that formula right with used EVs.
Yeah, I think there is. If you think about the dealer market, there is a period of transition. The used battery electric vehicle is starting to stabilise. Data that we're seeing when we start to look at our wholesale data as a percentage across new, it's starting to stabilise out now. It's actually started to increase in certain age profiles and certain makes and models, because they are starting to offer such a good value. And you are now starting to see those used car buyers that think, you know what, this is a great second car. I can drive this every day, Monday to Friday. It does my job. I've got a whole charger. I don't need to go that far. It's a great used car. It's a great second vehicle for the family. And at the weekend, we can jump in our hybrid, we can jump in our plug-in hybrid or our ICE vehicle. There is that now starting to play. And I think clearly, if you go back to what's happened over the last several years and you look at that market share fall of diesel, your choice of diesel new is diminished significantly. $100,000 diesel registrations last year, 142,000 the year before. There are fewer used diesels in the used vehicle park in that 0 to 3 year old, and it's reducing. The same starting to happen now with petrol. So for retailers that operate in the 0 to 3, 0 to 4 year old market, your choice of non-hybrid, plug-in hybrid, and EV is diminishing. Choice of 12-month-old, 24-month-old, 36-month-old diesels is small. It's declined significantly. So the retailers have got to think, actually, I've got two choices. Either I move my age profile older, or I start to think about what my profile looks like. And if it has to be made up of more hybrid, plug-in hybrid and EVs, how do we get the knowledge and expertise into the showroom to have those conversations with the consumer so that we can start to buy these vehicles? And I think clearly indications are through various different outputs that days to sell on EVs is shorter than ICE vehicles. Minimal prep. If a consumer is out looking for an EV, they've made that decision, they're looking for an EV because it suits their profile, and they offer some fantastic value as a used proposition. What we need is more of that to make it viable for the retailers.
Fantastic. Okay, Philip, you recently warned the VRA that the remarketing sector is under threat from cybercrime due to rapid staff turnover in dealerships. What is the one human weakness in a typical car business that a hacker is going to exploit today? Now, I'm not sure if this answer is going to leave anyone exposed or compromised, but let's go for it anyway.
No, I think generally, you are down to that, the individual within your organization opening an email, clicking a link, doing something themselves that exposes that business. And I think one thing that we were trying to make clear at the VRA meeting was that we see all the things, whether it's Marks and Spencer's, whether it's Co-op or whether it's JLR, we look at it as these big organizations. We're trying to get the message across. It's not just the big organizations. It's every organization, however large or small you are in the sector. And it's not just those kind of areas of the sector. It can happen to any business just by the click of the wrong email, the wrong link within the email. And I think that's what we're trying to get across to the vehicle remarketing sector, that clearly you need those processes and policies in place. You need to implement them, but you need to do the training and knowledge around that you're not exposing yourself to any kind of cybercrime in the marketplace, because it may come through you as a smaller business, but actually end up with a larger part of your organization or your parent company and things like that. So that's really what we're trying to get across at that meeting.
And now, Philip, time for a lightning round of 3 questions. And I'll start with the first one. We've covered some of these things, but it was worth talking about them again. What would you say is the most bulletproof used car segment to stock right now?
Wow. Two areas that are playing out. I'll answer this with 2 really, but sub £15,000 is very strong at the minute, and £60,000 and above is a very strong market as well. The 15,000, 20,000 and above up to 40, 50, 60,000 is the more challenging sector at the minute. Operators in that sub 15,000 are doing very well, but it's also becoming quite competitive at the minute. And the above £60,000 seems to be a little bit more immune to some of the cost of living and economic challenges that we're facing at the minute. It's that middle section that is under pressure in general.
Second question, will the end of the employee car ownership scheme this October really wipe out 10% of registrations?
The employment scheme has been deferred, and I think by the time we get to the deferment date, which I think is around 2029 or 2030, then I think a lot of the operators that use that scheme will have looked at alternative ways of managing that volume in their business. So I think it was good news that the government deferred it and from this October, but it is still on the horizon to end. But I think going back to our opening conversation, Adrian, anything can happen, let alone in 2 or 3 years. Anything can happen in months and weeks at the minute in the current climate. So I think the good thing is it's delayed an area of the sector that could and would have had a significant impact on the volume in the marketplace.
And that brings me neatly to my last question. One word to describe the state of the UK residual car values by Christmas.
Volatile still.
That's 2 words, but I'll take it. That's great. Thank you very much. It's been great to talk to you. I've thoroughly enjoyed it. Thank you.
Thank you, Adrian.
That was Philip Nothard giving us the strategic reality check that we needed on the 2026 market. In a world of fragile foundations and push registrations, Philip has made it clear the data you ignore is the profit you lose. But having the right car at the right price is only half the battle. Next week, we're looking at how you actually sell in a digital-first world. Joining us is Jens Peter Schoberg, the Chief Innovation Officer and co-founder of Firon. JP didn't start in a showroom, he started in Hollywood, working on blockbusters like Lord of the Rings and Superman Returns. Now he's brought that cinematic artistry to the motor trade, using AI to turn static inventory into automated, high-converting video at a scale that was once impossible. We'll be asking JP if AI really will be selling cars and how dealers can stop being inventory managers and start thinking like Hollywood producers. You've been listening to the Automotive Business Podcast. I'm Adrian Simpson, and we'll see you on the next shift from the forecourt to the fleet.